So, hello to all the new and aspiring investor and traders. Today, in this video, we will discuss in detail from basic to advanced concept of share market. Before we begin, I presume few terminology that keep hovering around your mind is like what is share market? Is it just about Sensex or just about Nifty? And also, questions like is there only these terms or are there any more? And if you are more advanced than a newbie, then you must have also heard of NSE and BSE. The very first nostalgic image that you have seen having read the news of share market in India is about this building. This building is called as Bombay Stock Exchange or the BSE located in Mumbai. On the right side, you see the National Stock Exchange NSE building headquartered in New Delhi. Other than these, there are two more famous symbols that makes a young financier inquisitive about. Yes, every country has this statue of bull before the building of their respective country's stock market exchange. You must have also come across the image where bull and bear are fighting each other in either newspaper, magazine, or social media related to finance. Now, it is always the first time that we hear about finance world of stock market from someone or the other. Like in my case, I heard it from a very famous web series Scam 1992, which was a real life story of Harshad Mehta. In this web series, Harshad Mehta is being shown as a big bull of Indian stock market, while the other group was shown as the bear cartel group, who were represented from the real life character of Manu Manek, Mr. Jhunjhunwala, and Rakesh Damani. So enough with the introduction. Let us directly jump to our journey of learning all about the share market in depth. Before we begin the educational part, let me tell you that while watching the video, you must keep few things in mind. Do not skip this video because some points may be used later on in this video and you will have the trouble to correlate with the topics ahead. And don't rush to open the Demat account just by seeing the intro video. Watch the entire video first, analyze your potential and understanding in share market. I would suggest to try a paper trading in investing, and after spending few months of your research, if you find yourself skillful enough, then go ahead to open your first Demat account. Now, to begin with, let me explain you by an example. Suppose you want to buy a motorcycle. What you do? You pay the price and in return you get the motorcycle. Or anything that you buy in the market for immediate use in your daily life is called as essential commodity. But if you want to buy shares of Reliance or Wipro with a vision that when the company will grow, your money will also grow, what you buy a share is called as a virtual partnership. Though this partnership does not allow you all the rights in the company, but as a retail investor, you do enjoy certain rights, dividend rights, etc. So, just after buying a share, you can't just go to the company the next morning and start shouting that I own the partnership in this company, so give me some privilege in it. Look, the basic funda in the stock market is to earn money more than you have invested in it. The stock market has the potential to multiply your investment by more than in the range of 5 times to about 1000 times. Let us just see the growth of Reliance in different time period. Don't worry if you don't know how to read the chart. Just follow the directional flow of the arrow. So I am setting the time frame of 1 year. Let us say you invest at rupees 2100 at around in the April of 2023. You see the share price has risen from there to up to 2800 and you get a return of 33%. Now I am setting the time frame of up to 3 years. Let us say you invest at rupees about 1000 level in the month of June 2020. From there, you get a return of 180%. It is almost 3 times. Now changing the time frame up to 15 year. Let us say you invest now at rupees 500 level. You get a return of 460%. I think it is almost 6 times. Now the time frame is since the IPO listing in Reliance. That is in the year of 1997 and the price you buy I think is the level of 35. So when you invest at 35 you get a return of almost 70 times. That is 6900% return. Now what does this mean? It means an investment of rupees 1 lakh in 1997 would have made your money a net worth of 70 crore approx. So this is what a basic of share market investing is like. But there goes a saying that all days are not glory. Bad things may happen and you may also end up losing all your money. That is why most people want to stay safe by making fixed deposit in bank or invest in the government scheme rather than trusting the so-called risky stock marketing. And yes, this is a point where I must also mention that I am not luring anyone to invest in share market. You must also keep in mind that this is just one of the option of investing, just like gold or property. Let us now go in more detail. Suppose Wipro need to expand its business. So they need money. So what a company does is that it issues shares of some value in the open market, be it like rupees 400 per share. In this way, whoever buys a share, suppose we public, so the public money goes into the business expansion of companies, say it like Wipro. Now the company cannot just come on the road and start shouting like take my shares or buy my shares like a vegetable or fruit vendor. So they need exchanges like NSE or BSE which act as a shop or you can say like mandi from where you can buy shares. As a retail investor, you are allowed to buy shares either from NSE or BSE and you can sell on any of the platform irrespective of from where you have bought the shares. Also that you cannot just go and directly buy the shares. For buying the shares, you need a broker who will buy shares on your behalf and maintain all your investment in different companies in one place which is called a demat account. Examples of demat accounts are like Zerodha, Angel One, and there are many. So the advertisement you see on the television about Angel One or the Grow app, these are actually the demat service provider. Then at last comes we, the retail investor, who hold the demat account and watch their investment growing. Now let us look what are the time of this exchange when you can buy and sell your share. So for the majority of the market, the timing is 9 am to 3:30 pm. Next, we will see all type of market. First being the delivery market. In this, basically you buy a share and you are allowed to sell it after the settlement period, which is usually the T plus 1 day. So that means that when you buy a share in a delivery market, you are only allowed to sell in the next day. Now, when you hold a stock for more than 365 days, or you can say more than 1 year, it is termed as long term investment. And when you buy and sell a share between the next day of buying and less than 365 days or 1 year, it is termed as short term investment. Next very popular market is the intraday trading, where you have to buy and sell the share within the same day before 3:15 pm. That means all the trade and settlement should be done on the same day between the trading hours of 9 am to 3:15 pm. The option trading is like prediction of a cricket match. When you say that the prices will go up to a certain level, either up or down, and if it goes in that way, it is like you have your reward. Futures is generally used for shorting of shares in the stock market. For example, suppose you want to do a reverse of buying and selling. That is, first you want to sell a share and then buy it when the prices go down. So in that case, if you do not have that share in the first place, how can you sell it? So for that, we use the future of that stock. In the currency market, you buy the different currencies of different countries across the world and trade among them when the prices go up or down comparatively. The commodity market is like the actual shop we see in our day-to-day life. You see the listed price of various commodities such as the gold, iron, or the food products, etc. And you trade according to their prices going up and down. Let me now tell you the order of my preference on which market should one choose. As per my personal experience, delivery market is most safe among all. Look, the commodity and the currency market are also safe, but I am talking about the majority market. So, the delivery based trading or investing is mostly the safe one. Whereas the intraday and the future and options are highly risky, and 95 or I must say 99% of the traders usually end up in losing money. So it is basically this section, the intraday and future option, which is the black sheep of the share market and is like cricket betting. So my personal suggestion is never go for the intraday or future and option. Though nowadays on the Instagram or any other social media, you must have seen many influencers try to show their profit statement and claim to have earned lakhs of money in the intraday or option trading. But believe me, they are just recovering their lost money. Other privilege you get after you buy a share is as follows. Dividend is the money company pays to its shareholder directly to their bank account without having to sell their share. Why the company do so? Because it must be in a huge profit, and also to attract the new retail investor, because in the market dividend paying stock has a different fan base. If I explain you dividend in a humorous way, for me dividend is like a pocket money for the promoters. Suppose Mukesh Ambani has to give pocket money to his wife and children, so he will announce a dividend. And since they hold crores of shares, so they will get huge sum as the pocket money. This is just a humorous explanation of dividend. If you stay in share market for a long time, you are going to hear one another term, which is a buyback. Suppose a company's price has fallen from rupees 1000 to 500 and you bought 100 shares at the low level of 500. So, few companies who have a very good profit in their balance sheet, what they do is they ask you to sell your share to them at an offer price, which is usually less than the high, but it is the price more than your buying price. If the company price has fallen from 1000 to 500, then the company will offer to give an instant price of rupees 800. So you get an instant profit of rupees 300 since you bought it at 500 and selling at 800 without having to wait for that long period. A buyback is always believed to represent good financial background of the company. Next important term is the right issue, which you can say is a reverse of a buyback. Here, let's say you bought 100 shares of a company at rupees 10 and now the company price is around rupees 50 and you are in a sad mood that you should have bought more share at rupees 10. So what sometimes happens is that the company announces right to its shareholder. It means though the company current market price is trading at rupees 50, but to its old shareholder it gives few share at less price, say rupees 5. So you get an opportunity to buy more share that you were wishing to buy. When the company issues rights, it is also considered to be reflecting good financial background of the company. Let us discuss now what makes the share price to rise up or fall down. The basic reason for the rise of the price is the increase in demand of the share of that particular company. Or if the demand is exhausted, the share price falls. Let me explain you with an example. Let us say that a movie has been released and there are 1000 seats and price be rupees 100. So if there is a buzz that movie is fantastic, there will be a huge crowd in no minute. And even if the theater owner raises the price to rupees 200, then also the people are willing to buy because there is a great demand to watch the movie. So, in the market term, suppose if there is a news about a company that it has got a huge tender with let's say government of India, then there will be a huge buying sentiment for that company, resulting that the people will start buying the share so that the demand has increased. So the promoter of the company will make the price of the share more expensive, and here this way the price will go up. And vice versa, if bad happens to a company, people will start to sell their share and demand will decrease. So the company will make the price cheaper and so the share price will go down. So I think now the concept of how the price action take place in the share market is well understood to you all. Now let us quickly understand what is market capitalization of a company. When you will do your research to find the stocks, you will come across the term which is market capitalization. It is usually the current market price multiplied by total number of share a company issue in the open market. So it is basically of three category: the large cap, the small cap and the mid cap. See, there is no specific spectrum to define different market capitalization, but what is used in a wider perspective is presented before you. So, a large cap are those stocks whose market capitalization is more than 1 lakh crore. Mid cap are those stocks with the market capitalization more than in the range of about 30 to 50 lakh and up to 1 lakh crore. Small cap are the stocks whose market capitalization is up to, you can say, 30,000 crore. So, what are the blue chips company then? See, they are basically those company on which you can say the nation trust. Trust in the sense, if these companies share price start falling all at once, you can say that the financial crisis has arrived in that country. In India, if I give a few example of blue chip companies, Reliance, Tata Group, TCS, Infosys, Wipro, HDFC Group, SBI Bank, and many others. So, yes, you can say that these blue chips are 80% large cap companies and few 20% can be from mid cap that can become large cap in coming year. For example, the IDFC First Bank. It is my prediction, not any compulsion. See, here I would like to mention one thing, that you can't say that a large company is safe or a mid cap company is safe or small cap, because every large cap company was once a mid cap or every mid cap was once a small cap. So a buyer sees an opportunity in these small cap company which will later on become a mid cap, or a mid cap becomes a large cap. So in this way the investor multiply his income with the growing market capitalization of that particular company. So the capitalization and the blue chips aside, so what are the penny shares? This term is very popular among the new investors. See, don't get confused that penny stocks are small cap companies. Let me give you an example. See, Rajesh Exports is a small cap categorized company, but it is not a blue chip because its current market price is around 500. So, you see that market capitalization is a different thing and penny share is different. The stocks whose share price is either you can say below 1 rupees, or in some website it is stated to be below 10 rupees or 50. These are termed as penny shares. See, the penny shares are high in rewarding, but they are very risky. So why does penny share attract the new investors? See, it may be because new investors generally come with low capital to invest. They have misconception or presumption that penny stocks are always the multi-bagger. Or the third point is that there is a psychology that you get huge number of share, so that the psychology effect make you believe that you hold large number of share of a company. This give you a feel good factor. So till now in the video we have learned all those aspects which you have to know just for knowing. You all must also be getting curious to know what's ahead. So we are going to learn about all those ingredients, which is quite helpful for deciding the trend of a market. Also, you must have seen a lot of it in the social media where people are posting a lot about the candlestick and the pattern they form. So, let us quickly get going with the introduction of all the candlesticks and their patterns. So, the first thing first, what is a candlestick? See, the candlesticks are used to identify the trading pattern, which help the technical analyst to set up their trade. See, you can say it like these candlesticks pattern are used for predicting the future direction of the price movement. The candlestick pattern are formed by grouping two or more candlestick in a certain way. So first, let us know what candlestick is. See, for the invention of these candlesticks, we should be thankful to the Japanese. They invented it, I think, 100 years ago. So on the figure, you see two candlesticks. One has a red color and one has a green color. So the thick part you see is called as the real body, which is rectangular in shape, and the two sticks that you see on the top and the bottom are called as wicks. And the top of the wick is actually the highest price the stock has touched on a particular day, and the lowest point of the wick is the day's low of the stock. And the real body, how is it formed? See, uh, the open price and the closing price, the range of these form the real body of a candlestick. See, the strength in the market is represented by a bullish or a green candle and a weakness by a bearish or a red candle. One should ensure that whenever there are buying, it is a green candle, and whenever there are selling, ensure that it is a red candle. First, we will discuss all the bullish candles. So, the first one being the hammer candle. See, a hammer candle is a green candlestick pattern that is formed at the end of a downtrend, and the signal is bullish reversal. And the real body of this candle is at the top, and usually it is very small. The candlestick chart pattern has no or little upper shadow. See, the psychology behind this candle formation is that the prices opened and the seller pushed the prices down. Suddenly, the buyers came into the market and pushed the prices up and closed the trading session more than the opening price. And so, this resulted in the formation of a bullish pattern and signifies that the buyers are back in the market and the downtrend may end. So, a trader can enter a long position if the next day a bullish candle is formed and can place a stop loss at the lower of a hammer. Next is the piercing pattern. You can say it is very tough to find and is very less popular. So, it is formed after a downtrend indicating a bullish reversal. It is formed by a two candle. The first candle being a bearish candle, which indicates the continuation of the downtrend. The second candle is a bullish candle, which opens gap down but closes more than the 50% of the real body of the previous candle, which shows that the bulls are back in the market and a bullish reversal is going to take place. Look, now onward from this part of the video, we will not discuss about where to enter or where to set your stop loss. For that, I will dedicate a separate video. So let us continue with just the introduction of the candle and the candlestick pattern that they form. So next we move is the bullish engulfing candle. So it is a multiple candlestick chart pattern that is formed after a downtrend indicating a bullish reversal. It is formed by two candles. The second candlestick engulfing the first candlestick. The first candle is a bearish candle that indicates continuation of the downtrend. The second candlestick is a long bullish candle that completely engulf, or you can say that the white will totally cover and go beyond covering, or you may say that it eats up the when you it will totally overlap the bearish candle. So again it indicates that bulls are back in the market. See, the hammer was the single candlestick pattern. Bullish engulfing was double candlestick were involved. Now the morning star candle, it involves multiple candlestick together. You can say a group of three. So which is formed after a downtrend, indicating a bullish reversal. It is made of three candlesticks. The first being bearish candle, second being a doji. We'll discuss about the doji in the later on this part of the video, and the third being a bullish candle. The first candle shows a continuation of a downtrend. The second candle being a doji indicates the indecision in the market. And the third bullish candle shows that the bulls are back in the market and the reversal is going to take place. See, one point is to be noted that the second candle, the middle one, it should be noted that it is completely out of the real bodies of the first and the third candle. See, whatever patterns you are seeing, there exist totally opposite candlestick pattern of these, and those we will use in the discussion of the bearish patterns. Okay, like for example, this is the morning star, so the bearishness of this pattern will be a evening star. So keep watching the video. So next is the three white soldier. See, again it is a multiple candlestick pattern, or you can say that it involves three or more candlestick pattern, and it is formed at the downtrend. And when you see, it is a three Maribozu candlestick that indicates a very strong bullishness, because you see three green candles and it's the end of the downtrend. And again they have the long shadow and are open with the real body above the previous candle in the pattern. Since the word Marubozu came in the discussion of three white soldiers, so let us now discuss the white Marubozu. What is it? So it is nothing, it is a single candlestick. The open price and the close price totally covers, and there is no wick formation in this candle. So you see a pure rectangle all covered in green. Either it is green color or red. It may be, the color doesn't matter, but you see the entire real body with no wicks in it. So if it is a green at the formation of this candle, when you see it is totally green, the sellers should be cautious and means close their shorting position, and obviously the buyers will have a green eye on the stock. So again we have a combination of three candlesticks, and this time it is three inside up candlestick pattern. It also indicates a bullish reversal, and since the continuation was a downtrend, so the first candle is formed is as a red bearish candle. The second candlestick being a small bullish candle, which should be in the range of the first candle. See, later on in this video we will discuss about the inside bar candlestick. So you see in this figure of three inside up, the second candle is actually a inside bar candle. See, so the third candlestick should be a long bullish candlestick confirming the bullish reversal. So the relationship of the first and second candlestick, you see only when you see the first and second, this is the bullish harami candlestick pattern. See, okay, see, you should not be obscene with the word harami, because this is a Japanese word. It is not which you use in the Hindi slang language, so you should not feel uncomfortable. So with the introduction of bullish harami, let us now discuss what actually is a bullish harami. See, again it is a multiple candlestick pattern, or you can say it is it involves the two candles, and it indicates a bullish reversal. Now we will discuss about the tweezer bottom candlestick. See, you basically you don't need to remember all these terms. Only you have to see and memorize the pattern that they form. Like in the case of tweezer bottom, you see that first is a Maribozu red candle, and from the closing point, that is the bottom base, from that point the lows of both the candlesticks are same, means the next candle is formed, the opening price is the low of the first candle, and from there the stock made a top till the top of the previous candle, but the little bit of you can say the bearishness was there, so the closing price was low, but still the you can say who won the race, the bull gang won the race. So ultimately a green candlestick was formed, so means it is an indication that bulls are back in the market and an upward trend is going to continue. Now whatever we have discussed, that were very popular bullish candlesticks. Now let us discuss some bearish candlesticks, and the first one being the hanging man. See, you saw what a hammer candlestick is. It must be looking very similar to you, the hanging man. Only difference is that it is red in color and it is always formed at the uptrend. Means the hammer was formed at the downtrend of the market, and the hammer has brought reversal in the bearishness, and the bullish were taken over in the market. So the reverse is that the hanging man is formed at the uptrend, and it will bring the downtrend in the market. So when you are holding a position at the very low and you see that the market has already gone too high and you see a hanging man being formed, so you must exit from your holding. The dark cloud cover candlestick is you can see it is a reverse of the piercing pattern, where now in the uptrend when a green candle was formed and it is followed by a red candle which will close its closing price below the 50% of the real body of the previous green candle, and hence it will bring the downtrend in the market. See, whether bearish candle or the bullish candle, if you have learned about any one of these, so you know now that the same opposite candlestick will exist. If you have learned about the green candle, so a red candle will exist which will bring the bearishness in the market. See, like for example, the when you have studied about the morning star which was formed at the downtrend, so reverse is the evening star which will be formed at the uptrend. When you have three white horse, so you will have three black crows which will be definitely three continuous red bearish candles. You will read about the white Maribozu, so you will have a black Maribozu. If you have the bullish Harami pattern, you will have a bearish Harami pattern. So you know that there exists a opposite of the candlestick pattern that whichever you learn. Okay, as we have read about the inverted hammer, so you have the shooting star candlestick now. So these doesn't need a lot of introduction, because by just seeing, since we have already discussed in detail about the bullish ones, so you know what exactly opposite the red candles are going to do. So one candlestick that was left to be discussed was Doji candlestick pattern. See, these are of various type, but the similarity is that when the opening and the closing prices are almost the same, the candlestick pattern looks like a cross with a very small real body. but the very long shadow means the wicks that you see, long sticks, they will be very big, but the real body will be very small. And when when real body is a little bit big than being very small, then you see a spinning top being formed. But these all are the category of doji pattern, and they represent the indecisive uh, in the market, like no one can decide who is victorious, either bull or bear, and hence a doji pattern is formed. See, sometimes what happens is that just one candle is enough to change the momentum of the market. So, a candle is alone important also. But now we are going to look when we combine many candles in one, means when we look at the charts on a wider time frame. So there different type of candles all together form some sort of pattern. So we are now going to look what are the candlestick pattern when combined together. These are called as the chart patterns because we look at the entire chart. So you see now that the chart patterns are an integral aspect of technical analysis, but they require some getting used to before they can used effectively. So to help you get to the grip with them, I must like to present before you some important chart pattern. Means there are many chart patterns, but I would consider those which I use frequently, and they are also very popular among the traders and investors. See, these are the patterns that helps to suggest what prices might do next based on what they have done in the past. See, when I begin my investment journey, I did not have access to these because in India, internet was not so much rampant. But for you, I must say that this is exactly what you must, I must say, you must mug up so that you exactly know which point to enter and which are the point you must sell your holding. And you among these you cannot say which is the best chart pattern for a particular market, and using the wrong one or not knowing which one to use may cause you to miss out on opportunity. It's nothing like that. So before getting into the intricacies of different chart pattern, it is important that we briefly understand what are the support and resistance level. See, support refers to the level at which an asset's price stop falling and bounce back. Means if there's a downtrend and the market is going down and down, and the point where it stops, this is the support point. And so exactly opposite is the resistance point, where the prices usually stop rising and dips back down. See, the reason level of the support and resistance appear is because of the balance between the buyer and sellers, or the demand and supply get balanced out. When they are more buyer than seller in the market, or demand is high, the prices tend to rise. When there are more sellers, the prices usually falls. So to begin with, let us start with head and shoulder pattern. The head and shoulder is a chart pattern in which a large peak has a slightly smaller peak on either side of it. Traders look at the head and shoulder pattern to predict a bullish to bearish reversal. Typically, the first and the third peak will be smaller than the second, but will all fall back to the same level of the support, otherwise known as a neckline. Once the third peak has fallen back to the level of support, it is likely that it will break out into a bearish trend. The name head and shoulder suggests means from the picture you can see that the middle one is forming the, it seems like a head of a man, and both sides the shoulder, it appears to be a shoulder. Now the double top pattern. See, the double top for me, I have found this in a very blue chip or financially strong companies, and they form the double top and go into a downtrend, breaking the neckline. So a double top is another pattern that a trader used to highlight trend reversal. Basically, an asset price will experience a peak before retracing back to the support level. It will climb once again more, reversing back to the permanent against the prevailing trend. So what you finally see is that two mountain type structure is formed with two peak. So that is the double top, and the reversal, you can say the opposite of it, is the double bottom. So nothing need to be explained here. Now the next one, one of my favorite, and when you will learn about it and experience it in your daily life, means daily life of your trading, then you are going to make this one as your favorite too. It is cup and handle pattern. The cup and handle pattern is usually a bullish continuation pattern, which I would say that it is used to show a period of bearish market sentiment before an overall trend finally continues in a bullish motion. The cup appears similar to the rounding bottom chart pattern. See, I have not mentioned this rounding bottom, but the part of the cup, this is only a rounding bottom chart pattern, and the handle very similar to the wedge pattern, which is explained next, which I will explain in the next section. Okay, so I think it is a combination of a rounding pattern and a wedge pattern. See, following a rounding bottom, the prices of an asset will likely to enter in a temporary retracement, or you can say consolidation phase. Okay, which is known as a handle, because this retracement is confined to two parallel lines on the price graph. The asset will eventually reverse out of the handle and continue with the overall bullish trend. And when you see, suppose if I want to explain that, I can explain it with the example of when you will look at the chart pattern of Sun Pharma. See, it was in a cup and handle formation for over a period of 5 years. So the blue chip stock, when they have to give a breakout, they use this pattern. It's very simple. And the investment point, you have to invest at the bottom of the, either you invest at the bottom of the cup, but many investors fear, because at that time the news around that stock is quite negative, so everyone stay away. But when it is going giving a breakout at the handle point, then a lot of people enter. But my suggestion is that you are missing out the full cream of the stock price. When you have that gut, when you know that it is going to form a cup and handle pattern and enter at the base of the cup, so the reward is huge for you. So that the next one is the wedge pattern. uh, See, the wedge forms and the price movement tighten between the two sloping trend line, either downward going wedges or up going wedges. See, the catch here is a falling wedge. Whenever you see a falling wedge, and the stock, when it gives breakout, I mean when it get out of the falling wedge, it goes upward. And when there you see rising wedges, then the breakout is always downward. So this is a very catchy point of this stock. Whenever you draw a trend line and you see a falling wedge, so it means that some or the other time the stock is going to give a breakout and it will go up. And the reverse, when it's a rising wedge, so it will go in the opposite direction, that is downward. See, next is the pennant pattern. See, when you draw a trend line, you will see the converging trend line and forming a tip till as a triangle, you may see. Okay, and the breakout, if it is coming from a downward direction, I think the pen then after getting in the pennant form, it gives breakout in upward direction, and when it is going coming from a upward and entrap in a pennant, it is going to give a breakout downward side. Next we have two more um, chart pattern which appears to be same as or that of pennant pattern, that is ascending triangle pattern and descending triangle pattern. Since the triangle is formed, you can see it is quite similar to the pennant and the breakout discuss. See, the only difference is in pennant, when you draw trend line, both are means none of the lines are parallel to the horizontal, but in the triangle pattern, but just the name being given, so the baseline will be always means perfectly parallel to the horizontal. That is the basic difference I find in among these three pattern. Then one of the very important one is the flag pattern, which I have shown you in the cup and handle also. So how does it make a flag pattern? The flag stock chart pattern forms through a you may say a rectangle, means when you join the trend line it shows a rectangular pattern, means it looks like a wedge. The rectangle develops form of two trend line which form the support and resistance until the price breakout. The flag will have a sloping trend line and the slope should move in a opposite direction to the original price movement. Once the price breaks through either the support or resistance line, this creates the buy or sell signal. See, for now, I would like to just sum up for you, because I think for the basic knowledge, it is more than enough. Because in this, I have also included a short summary of how the price action works in the share market. I have given the introduction here of the price action also because I want you to go into the depth of this section also before entering into buying a stock, so that every time you can get the best price at the buying level also, and for selling you can reap the maximum profit out of it. So if you have watched the entire video, I think you must be very excited to go and open your first Demat account and then buy a share, get some profit out of it. So sure, you can go ahead with it, but do subscribe to our channel, because I show my way of picking up a stock, means whatever the chart patterns you have seen in the theory, I show them in a practical way. Or I always have a practical approach of choosing a stock, not on just on the base of news or other thing. It is totally, I think 99% it is on these theoretical part, the chart patterns, and believe me, they give you quite handsome amount of profit, other than those stocks which are in the news for some time, or you may say that they are already trading at a peak level, then the news come out, you get trapped into them, and then the operator makes the stocks to fall, and you wonder, when the news was good, why has the stock fallen? So if you have anything to say, please write it down in the comment box. Thank you for watching.